everyone. It's 5 o'clock sharp, so time to start our webinar. I am delighted to welcome you all to the third webinar in a series of 5 on the topic of raising venture capital with impact. This series explores how entrepreneurs can successfully use impact measurement to raise funding from existing and emerging venture capital funds. Today's webinar will focus on how a new generation of VCs is challenging the status quo. For those that have missed webinars 1 and 2, you can catch up at the EIB Institute YouTube channel where all recordings are available. For those that are joining us for the first time, I am Luísa Ferreira, Head of Social at European Investment Bank Institute. The EIB Institute is the philanthropic arm of the EIB, the EU Policy Bank. It's my pleasure to introduce you to today's speaker, Wladimir Nikoluk. Wladimir is the CEO and co-founder of Immerlearn, an advanced data analytics consultancy that helps entrepreneurs and investors to manage and increase their impact. In today's webinar, we'll deep dive into pure impact VC funds that have emerged in the last couple of years. And Wladimir will be joined by two special guests, Camilla Dolan, one of the founding partners of Eka Ventures, and Tomas Kemtys, a partner at Contrarian Ventures. Both Eka Ventures and Contrarian Ventures are two examples of pure impact VC funds. Before I give the mic to Wladimir, few logistic remarks. One is this webinar is being recorded and will be available in a few days in the Institute's YouTube channel, together with all the webinars we have developed for SIT alumni and social entrepreneurs in general. How will we organize the session today? Wladimir will kick off the webinar with a short introduction on the topic, followed by a conversation with Camilla and Tomas. So if you have questions for any of them, share them on Q&A and please make sure that you use the option sent to all panelists. Finally, at the end of the webinar, we'll ask you to answer a short survey. So thank you for your attention, and Wladimir, now the floor is yours, or the mic is yours.
For having me and having us. Actually, I'm very grateful that Camilla and Tomas are available to join us today. They run some of the most inspiring, I think funds out there. And yeah, as you said, we're going to kick off with a quick recap of the last two sessions, and then really deep dive into some of the topics that are kind of great interest. So kind of we're going to start with first a deep dive on the various kind of on learning more about the funds, so Eka Ventures and Contrarian Ventures. And then we are going to deep dive on specific topics. So first of all, how is it that entrepreneurs kind of have come to found impactful companies? How is it that where is the supply in a way coming from? Why are entrepreneurs there that actually want to found impactful companies? How do we think about them? What is impact, right? Like, how do we distinguish impactful companies from non-impactful companies, and what's the relationship between the impact of a company and the company value? And then lastly, we'll have some advice from both Camilla and Tomas on, if you're an impactful entrepreneur, what do you need to know in today's environment? But so let's quickly do the recap, right? So I think one way to think about investing capital for impact is to have this vision of or this intention to generate positive, measurable, and social environmental impact alongside financial return, right? So financial return is not the only metric, but it is one of them. And there's a lot of different ways in which kind of this mission can be understood. Sometimes people understand it by just not creating harm. Sometimes it's about ESG, sometimes it's about positive screening, and sometimes it's about the really kind of narrow definition that it needs to be measurable positive return. And we've seen a lot of interest in that. So the funds essentially allocated to various impact categories are growing very rapidly, as we saw in the first session. And the question is like, why? So one of the things that really stands out is in almost like an ironic fact that the world, to some extent, is very imperfect. And although in the past centuries we had some amazing progress along literacy and decreasing child mortality and improving education and incomes for people, we are also faced now with an economic and social system that creates a lot of headaches for us. The concentration of CO2 in the atmosphere is at a 800,000 year high. We are looking at rising sea levels from about 0.5 meter to 2 meters, which would displace hundreds of thousands of people, if not hundreds of millions. Our resource consumption is unsustainable. We would need 5 planets if everyone was consuming resources the way we do in the Western world. Income inequality has become a huge problem, where the gains for the last 50 years were kind of half of it were actually captured by the top 1% of the world population. And on the other hand, we have created families, for example, in the US, where 40% of them are unable to absorb an unexpected $400 expense. At the same time, we see mental disorders, and we frankly see huge kind of power imbalances, right? Even if we look at something like COVID vaccines, then 10 countries have essentially access to 75% of all of them. And 100 countries have actually not received a single dose. So in a way, this context creates demands for better products and services that solve some of those issues. And we've started developing a common language around it. The most common, or the most kind of famous framework, is actually the SDGs. They fall into very specific indicators. And in a way, more and more companies and stakeholders are using them to communicate in a way their alignment. So for example, if you go on a fund like EQT kind of ventures, they would actually link every one of their investments to one of their SDGs. And this imperfection and this kind of newfound language has actually triggered also responses from various stakeholders. So investors are now reallocating trillions of capital from worse to better performing companies in terms of ESG. Philanthropists are putting more weight on outcome-based philanthropic projects that not only measure the output, but really like what has been achieved. Corporations are adopting ESG impact standards. Governments are shifting expenditures to kind of outcome-based contracts. Consumers want to work and consume more in alignment with their values. And entrepreneurs have started to actually come up with more scalable solutions to this kind of the emerging environmental and social challenges. And we've seen some of them. This idea that you can build a hugely impactful company and essentially create a lot of business value on the side has been kind of proven again and again, right? By companies like Zipline, Orcam, Tala, Indigo, and Dolan. This is just like a small slice of some companies that were founded in the last 10 years and that have really kind of grown rapidly and managed to have a lot of impact, but also create substantial business value. So one way, in a way, to conceptualize this whole everything that is going on very briefly is just to say, well, we have a huge financing gap, right? Like the SDGs are in a way our common understanding of where we want to be in the world, and there's just a gap to achieve those targets. We estimated annually at around $2.5 trillion that is just simply missing if we want to go there. And then there's also at the same time a surge in global talent founding impactful ventures. So kind of especially kind of the younger generations care much more about it, and they're willing to put their time and also the effort into building those ventures. And in a way, there's also an over-demand and undersupply of kind of genuine impact assets, right? So if you, for example, look at the private equity, but also at the public market space, people want to invest in impactful companies, but there are really not that many. So it seems that there is some kind of a way in which this could be used to generate even more business value from a venture capital perspective. And so some of the insights that you might take away from this is to say, well, because there is an annual gap, we need much more scalable solutions. So there's an unprecedented demand for scalable products with impact. Second of all, there might be opportunities to invest now in outstanding teams who build those type of companies, right? So because talent just flows there. And three, you might actually be able to charge almost like an impact premium if you can measurably have an impactful company, and you can kind of prove to your follow-on investors like PE funds or public markets investors that this is kind of an impactful company. And so I think what we've seen on the VC space is kind of two types of reactions. So sometimes new funds have just emerged, and we're really kind of lucky to have two of them actually with us today. But also traditional, in a way, VC firms have started to build impact verticals, if you will, right? Like pockets of capital that one way or the other dedicated to one or more impact areas. And that has been kind of like an exciting discussion that we had last time. And I think kind of a couple of takeaways from that discussion, we had La Familia on in Crandom. And I think from a traditional VC perspective, you essentially have both excitement kind of or interest in founding impactful ventures, but you also have caution, because for the traditional funds, they were around a little bit longer than more kind of the newly founded funds. And this is in a way not their first rodeo. So they actually remember very well this kind of boom and bust cycle that you had with clean tech. Kind of it peaked, the interest peaked essentially in 2008. There was a lot of investments. People thought this was really going to be the next internet, but then a lot of those kind of like things didn't materialize, and in a way there was also like a bust afterwards in terms of investment cycle. But on the other hand, we see a much more renewed interest now again in clean tech. So maybe this time it's really different, right? So from 2013 to 2019, 60 billion flew into only climate kind of challenge related tech alone. In 2019, 6% of all VC capital was actually dedicated to this one goal, and this is excluding education and healthcare and all of these other impact areas. And this has grown quite a bit, right? From 2013, when kind of the bust was kind of at its lowest, and it was 418 million. We are now up to 16 billion per year. But I think one really important takeaway from the whole discussion with both Crandom and La Familia was that impact will not cut you some slack. So like if you are applying for funding for a venture capital fund, you actually just need to be, in the first place, a really good business. And it almost doesn't matter whether you have impact or not. In a way, the rules for investing in you will always be the same, right? And so in a way, impact for them is like another category of businesses that are kind of growing quickly in terms of industry. It could be just similar to, say, AI, right? Or like how some VCs invest in blockchain. Those are just important trends that they want to capitalize on. But there's nothing very specific about impact that makes them, you know, in a way, be a little bit more lenient towards the IRR that they would expect. And one of the things I think that we mentioned was that there is still not a lot of proof that that this impact thesis, in a way that we described beforehand, in terms of talent, in terms of demand, really translates into better returns. And so here we have the study by the MIT, which actually plotted, in a way, software companies versus medical companies versus clean tech companies up until 2016. And what you see there is essentially that clean techs have a higher failure rate, and that clean tech also has essentially a lower return as measured by the IRR. So here there was one outlier with the sale of Next to Apple, which was like obviously a huge return for the investors involved. But if you take Next out, kind of clean tech seem to have performed kind of a decade ago lower than some of the other impact startups. And this is kind of also seen in terms of the returns to investors. Last point we noted was essentially that even if you want to start managing kind of your impact in a much better way, there's still a lot of confusion as to how to best do it. And in a way, what we see is a sequential build-up of impact management skills that in turn will translate into pressure on startups. So we will start first, most funds at least will start first with ESG, and they're working now hard to build a common understanding and language around indicators that you want to report. And then this will kind of turn into actual standards where, you know, people will have a very specific set of information that will always be disclosed at the fund and startup level. Then this will be pushed to measurability. So at some point, you actually want to kind of like have certain quantified metrics, maybe on emissions or diversity or on kind of product safety if you can. And then at some point, it's just really important to not have this as a nice to have, but also to develop some accountability mechanisms, both on the fund and the LP level, certain actions that might be triggered if certain ESG or impact criteria actually not met. So with this brief recap in mind and just like setting the stage, I think we have two amazing guests, and I would just love to invite maybe first Camilla to just you know, present a little bit about Eka Ventures, how it came about, how you think about kind of the context in which you've created this venture, and yeah, the stage is yours.
Cool. Thanks, Vladimir. So very briefly, I'm Camilla. I'm one of the partners at Eka Ventures. We're a new fund that is sort of targeting a close of 60, and we really raised the fund around sort of 3 core principles. So one is we believe consumer technology is what's going to enable some of these big changes to happen. Most sort of big trends are really driven by consumers, including some of the action that we're seeing on climate today. The second is we specifically wanted to set up a fund that was focused on investing into companies that are building with profit and purpose in parallel. And we view that as a commercial opportunity, which I'm really happy to go into a bit more detail around, as opposed to sort of a philanthropic approach to that. And underneath that, we have 3 main themes of interest, and also very happy to go into a bit more detail around those and why we have those themes. But one is sort of sustainable products and supply chain. We've made a couple of investments in that space. The second is around the consumerization of health. So we came from a very sort of mainstream investment background, and you know, one of the incredible things that we saw there was the power that consumer technology companies had to engage with individuals and to drive change and to drive sort of daily behavioral engagement. And we think that same application of technology could be used to really change how people approach healthcare and do it in a much less expensive way. And then the final point we're looking at is affordable access to basic products and services. And we think, again, there's just massive opportunity for data and technology to change how certain demographics are sort of treated by technology, and seeing some really exciting things there.
Excellent. Thank you so much for sharing. And yeah, looking forward to diving into the discussion soon. But first, we have Tomas. The stage is yours.
Well, thanks, Vlad. Have a few slides, but maybe I'll show them later. I think I'll give a brief 1-2 minutes who we are, and then we go into different topics. So I'd love to share a few things. So I'm a general partner at Contrarian Ventures. You know, you mentioned sort of new. We've been around for like around 3 years, so you know, didn't come to this game in last year, let's say, but definitely relatively new in the block. So we are a very specialized sector-focused fund. We don't call ourselves impact. We don't use this word that much because just so many things are, so much of that impact is implicit in our thesis. So sort of we don't create this extra layer. Our sector focus is clean energy, clean tech, and electrification of the mobility, sometimes diverting to the smart mobility as well. And that sort of means kind of to us in very simple terms, from fossil fuels, the polluting elements of the earth, to really electrons, and especially green electrons, the electricity, the renewable electricity, or even renewable energy that will impact so many things in our lives, starting from buildings to how we consume energy, what kind of energy we consume, how we travel around, how we charge, how we fill our cars with energy, and how, you know, how we interact with energy, and sort of how to make it more attractive to the consumer. So all of that kind of thing, and these thematics. And we've, you know, been around for a few years. We have 17 companies in our portfolio addressing very different things, starting from carbon offsetting to batteries, to EV charging, to how do you move around the city in a sustainable way, and how do you control the flows of the mobility in the cities. So we have investments all over Europe and Israel. That's our focus. Have very strong sort of history and relationship to Israel. Fantastic place to invest in, especially in the mobility space, and been there successful entrepreneurs. Have team around Europe, some folks in Lithuania, some folks in Netherlands and in the UK. And you know, we in general, we also, as you said, sort of new generation of VCs. What's very important to us is not only investing, and you know, and obviously everything we invest is kind of has an impact, and we'll talk about it later. But also, what's very important to us, and that ties back to the sort of impact and this clean tech movement, clean tech 2.0 movement that Vlad touched a little bit, sort of 1.0 versus 2.0, that I would love to touch. What's different this time? Because it's very important, I think, because you sort of looked at the failures and how the returns without Nest would look like. But also what we try to do is we have a massive sort of focus on the community of those type of climate impact investors. So we run, Energy Tech Summit conference. We just finished this Climate 50 ranking of the top best climate tech focused funds around the world, sort of ranked them in 10 categories. So all these things that sort of let us bring the guys together, and we're sort of very open, sort of very much sort of open source type of fund. Sort of look, I know there's competition. I know as there's so much money, so much dry powder in this space right now, everyone's competing for the deals, but we know it's fierce, but at the same time, we really want to run a collaborative process. We share deals with others. We sort of invite them to join how we think, join our conferences and so on. So really, given it's so important, we're not investing, I don't know, I have nothing against, simpler things. I think that it may be less impactful to the world, like, note-taking apps or marketplaces, which are great as well, great businesses, but sort of as this is so important for the world and for all the people around it, and I'm so glad more and more money is getting put in for this cause, and it's still very little, in my opinion, especially in the innovation and early stage sectors. So we sort of try to bring everyone together. But I think through some of the slides, I'll maybe tell a better story than just words.
Amazing. Thank you so much for sharing, and that's really clear. And yeah, I mean, sharing also your kind of view on it's good that actually more money is flowing into it. It's good that we have more capital. We can take more shots at creating those type of solutions that we need. Maybe then giving the mic back to Camilla. Camilla, maybe you can share a little bit. You just mentioned it. You think it's a great commercial opportunity. You think there's kind of all of these trends that make this investment more viable. Maybe you could just help us understand a little bit, like, how would you distinguish between maybe kind of traditional companies and companies that you kind of would like to invest in, and what in kind of the way you approach it makes you different than maybe a more traditional kind of VC that's been around for like 20 or 25 years?
Yeah, sure. So I think it's probably helpful to sort of, I guess, frame the landscape, because we get asked about this quite a lot, and including from companies who I think they sometimes think they're a really great fit with our mandate, and maybe they're not. So I think if you look at sort of impact investing, or how we think about it, is probably a spectrum. So on the very right hand side, you have sort of philanthropy that's very much just focused on sort of changing the world, but without any financial return. So we're definitely sort of not investing in that bucket. Then I think the next phase you get is sort of impact first investment. So that's investment where, the primary goal of the investment is to create a social or an environmental return, and the financial return is secondary. Then there's a space in the middle, which is, I guess, the space that we're sort of investing into, which is, the more generalist thematic impact investing. And that's very much focused on how what the company is doing. So we're really focused on companies where they found an opportunity that they think they can use data science or technology to improve a product or service in a way that couldn't be done before. And it's that like insight around impact that enables it to happen. So I'll take an example, because it's probably the easiest way of doing it.
Yeah.
So we're investors in a business called Urban Jungle Insurance. So Urban Jungle's focused on the renters segment of the market. So when you look at the insurance industry, like everybody knows that insurance is a really important safety net, particularly for individuals that are sort of less affluent, because they have such a low level of savings, as you alluded to early. But when you actually look, especially in the UK market, at contents insurance, which I guess covers everything that you own, 90% of homeowners have contents insurance. It's less than 30% of renters. Renters are typically the most vulnerable and also generally less affluent. And so there's this huge discrepancy in the market. So Urban Jungle's unique insight was one of the reasons there was a discrepancy was because incumbent insurers didn't actually want to underwrite that sort of 70% of the market, because they were looking at demographic data and had decided a lot of those customers didn't have great risk. So they felt they could use behavioral data, which is more accurate than sort of demographic data, to underwrite that risk. So they very actively targeted that market. So it's a huge commercial opportunity, because you have this like arbitrage in terms of penetration. And then it's also a sort of, because of their approach to underwriting and focusing on different underwriting criteria, they've also now proven out that they have better loss ratios than the overall sort of incumbent market. So we think this type of investment, where it's using really smart sort of data science to, like, I guess, identify a white space opportunity that's a commercial opportunity, and then serve a target demographic that's been traditionally underserved and needs that product in order to have security, is the type of business that we're looking to invest into. I think going back to like what we don't invest into as well is, I think there's a lot of discussion about ESG at the moment. So for us, we think sort of ESG and impact is really different. So impact is like what the business is actually doing, which we sort of just described. ESG we view as like how the business is doing it. So any business, whether it's like tobacco, or I think Coca-Cola bottling company is very high up on the sort of ESG scores, those companies do well on an ESG screen because it's about how they do business and they put in the processes to do. For us, we're only focusing on those businesses where we believe that they're making a sort of sizable change by doing something differently versus sort of going through a checkbox of like how to make sure they are sort of ESG compliant, although obviously we do also ask them to be ESG compliant.
Fantastic. No, that sounds great. And I think urban jungle insurance is such an amazing example, because it really solves like a pressing need of people that kind of want to get this insurance but couldn't get it, and are in a way underserved, right? Because of kind of a lack of technology and product. How would you, is there a way in which you actually, in terms of your analysis of those companies, do you actually focus on creating an impact management system for them? Do they have to report certain metrics to you? How do you go about, in a way, doing a due diligence on like the type of impact a company can actually have?
Yeah, so we definitely do that. So we think it's a really important part of it. So pre-term sheet, so a term sheet is when we sort of indicate an offer to make an investment. So pre-term sheet, we do two different things. We both have a session with the founder around motivation, given the stage we're investing at. Often, like, we are investing in intent rather than sort of actual outcomes. So we'll have a sort of session with the founder just to make sure there's an alignment. And then we've developed a version that we think is appropriate for venture of the impact management framework. And we will go through that with a given company. That will be a brainstorming session, and the aim of that session is to come out with 2 or 3 metrics that we can track over time. I think as we've been going through this, what we found is that our companies are very early stage, and so what metrics might be appropriate when we first invest, or like how they're thinking about it at that stage could evolve like relatively quickly over time. But so that's where the framework plus the intention is really important. They report on those metrics monthly, so we get all of the financial KPIs, and then we get the impact KPIs. And I guess the really key point to pull out there is what we're focused on is how does this impact KPI drive a core business KPI. So if you take that urban jungle example as an advantage, the KPI metrics that they look at is percentage of customers that they provide underwriting to. So if somebody wants a quote, like what percentage will they actually like deliver a quote to, and there's a sort of threshold within which they need to stay in. And they also look at like what the demographic split of their customers are versus the overall market. In that market, because it's a regulated market, that's very well tracked. And then they also look at price profitability per segment, and they have a promise to treat all customers fairly and not sort of price gorge the most underprivileged or less educated customers. And so we can like very clearly track those metrics over time, and then metrics that they're tracking anyway because they're a core part of the business. We actually also track in their case Trustpilot, because one of the big things there is around like accessibility, and so Trustpilot scores are like a great sort of indicator of whether they are accessible or not. I think one of the exciting things actually about that tracking is, if you take them as an example, they were doing some reviews around Trustpilot, and they found there were lots of social housing tenants that had switched from the social housing insurance product into their product because they found it less expensive. And so as a result of that, they're now launching a product specifically focused on the social housing market. So we're really seeing that by having this like disciplined focus, companies are finding more commercial opportunity, and because they are doing it from like, I guess, a place of authenticity, it's much easier to get traction on those products once they launch them.
Yeah, that's so fascinating. And maybe one follow up on that. So when you are kind of interacting with those with the startup and the team, did you get like pushback in terms of that maybe founders are really busy, they have to kind of keep building this rocket ship, somehow trying to keep it together, and then in addition they need to now kind of do those kind of impact reporting, right? How was that interaction, and what was the feedback from the founders themselves?
So it's a great question. It's something we worry about. We worry about it all the time. That we want to be backing the best companies. I think to date we found it's been the opposite. So the founders that I guess have been attracted to working with us, and we've been attracted to working with, have been like genuinely sort of impact driven, and so they wanted to have this conversation. And actually, a lot of I guess the improvements we're making internally are driven by some of the founders we're working with, because they're really hungry for information on how to do this properly, and particularly they're like interested in how you do it and maintain really good scale. And I guess some early examples of that is we have something called social objects that we ask companies to put into the articles, which just clarifies that the company exists for more than just their shareholders, which is what the traditional articles stand for. And we were really interested. We're like, it's going to be interesting once we start doing follow-on rounds into these companies. What actually happens to that social objects? Because I guess at that stage we have sort of less input than when we first invest. And what we've actually found is where we've had co-investments, those investors have often asked us how we do this, and they're thinking about adopting it in sort of businesses at a broader scale. And so what we're actually finding is there is, both with companies and with investors, there's a desire to move in this direction. And so it feels like it's really just helping those companies along that journey. I'm sure there are some that aren't. I'm sure there are companies that would just see it as a real pain, but I guess back to that founder intent point, if they don't think it's worth spending an hour and a half on this and it's not something they want to track over time, then we would have concerns that they weren't really committed to building in this way. And given the metrics are meant to be linked to commercial metrics, they should be metrics they're tracking anyway.
No, that's fascinating, because essentially you use in a way your impact focus as a self-selection mechanism for attracting the right entrepreneurs, and kind of in a way filtering out the ones that might not have the genuine kind of impact mission at the core of their mindset. Amazing. Well, I'd love to switch to Tomas also, to kind of ask you exactly the same question almost. What made you kind of in a way start Contrarian Ventures? It has a really interesting name in the first place to it, and how do you think about the companies that you want to invest in versus not invest in, and how are you different from maybe a traditional VC firm?
Totally. I thought you guys will not involve me anymore. You guys just having such a good chat. I'll just zoom out. Yeah. So the massive difference is definitely that we so sector focused. So so specialized. So plugged into that specific ecosystem and those specific entrepreneurs, so sort of you really get to know them. And the whole ecosystem much faster than if you were a generalist investor, at looking at sort of what industry comes to you. So especially, and also obviously early stage stuff is so much team driven, right? If you invest in pre-seed or seed things, you can have some great vision, but at the end of the day, it's really going to be the person or the team or the co-founders that will be driving it for the next 10 years. So, but understanding the industry, because it's slightly maybe more complicated sometimes than the other industries, is very, very important. So I think having that type of knowledge is crucial. Camilla touched some great points. I wanted to sort of comment or maybe suggest my opinion, but I can't now remember all the points she had. For us, it's in terms of impact. Sort of I think we think less about it than let's say the generalist funds that would go and be like, okay, look, so how is this going to work? Let's think about ESG. Let's think about impact measurement. Because 95% of the entrepreneurs that come to us or that we go to are sort of already doing this implicitly. So though what's maybe some more interesting source, I have seen more and more, given this, at least what I'm seeing, this massive bubble and a boom and hype in the clean tech industry, in the EV industry, with all the SPACs coming into space with insane amount of capital, people getting rich very, very quickly with just ridiculous financial projections, which is honestly different topic, about a very big distraction to some of our CEOs, which are sitting in Series C, and they see companies that are generating less revenues than them and getting 2 billion valuations for dreams that will not happen, and everyone knows it's not going to happen. Just the way the SPAC is structured, that you can disclose financial projections which are ludicrous. And they sort of almost start getting so distracted from the business, saying, look, maybe I should get this liquidity as well in the next year. Everyone's getting it, which is frustrating to us. But anyway, so I think we've been seeing more and more people coming into us, sort of almost coming with a very simple, not sort of clean tech or impact focused business, I don't know, some sort of delivery business. Look, but also I got the slide that for every delivery we bring, we're gonna plant the tree. Hence, we are an impact focused startup. Hence why we came to you guys. So, look, this is interesting. It's great, you guys planting trees, but it's not what it's all about. You can't just sort of artificially invent, an impact startup. Just, you cannot just plant a tree by, I don't know, selling tobacco and planting enough trees doesn't make you impactful. So anyway, so I think you guys have been touching so many great points. Maybe I'll skip some of the trivial stuff, but what things I wanted to comment, especially when Camilla was talking about, sitting down with the founders at the very early stage, or having those hour meetings and saying, look, how do you guys see the vision? I guess you see a lot of that during the due diligence when you speak to the whole founding team. You'll figure it out. Maybe people can trick you in an hour or two, especially over Zoom calls. But I think once you start digging in, you will figure out what they care about. But obviously having a plan is very important. What we've seen, however, some funds, I would say, overdo it a little bit. Maybe it's a little bit controversial what I'm going to say, but I've seen other funds that would come to our for follow-on rounds that's just still very, very early. It could be 12 people team, maybe raising, I don't know, a seed extension or something, and they call themselves impact funds, and which obviously they are, but you can, if the companies are so early asking for everything, that every sort of impact classification would tick the box at this point in time, when companies still pivoting or still really figuring out what they want to do, and then saying, look, you are not doing offsetting in the office, or you're not using the green energy in the office, or you travel too much, and our IC doesn't really like it that much. Maybe these are sort of more of extreme stories, but you probably get the gist what I'm saying. I think it's a bit of a, with all this dynamic that everything has to be ESG proved, impact all over the place. It's sometimes you should definitely talk about it, like what Camilla said, with entrepreneurs, discuss it, how it can be achieved, but it has to be a plan. You cannot just put this and say, look, you guys should do this. I'm going to check in every month. And, if you're not doing this, then it means you're not in the right mindset. I think, the business we'll look at are all sort of financially driven, but just with the right mindset of people that are doing it. And we do track the way we track things is we decide on a few metrics that are both business and impact related. So again, examples are always a good thing. I had this one company in the UK and US called Zumo, which came about when they decided that couriers of the likes of Deliveroo, DoorDash, Uber Eats should be earning more money and not spending so much energy on the delivery. And so what they gave them is they gave them a subscription method to subscribe for electric bikes, which they could not afford. The average driver cannot afford $3,000 electric bike for the work that's probably not going to do for the rest of his life. The average tenure is 6 months. So they gave them a subscription, the software, maintenance, insurance, everything for their peace of mind. So they could go do their work, earn more money per hour, and be more efficient. So for these kind of guys, what we track is really the bikes, the couriers that use that, the bikes that are in the play, the miles driven, saved, and so on and so on. With the companies in the battery space, we look at how much of the megawatt of bad energy has been now replaced with green energy, how much has been stored with carbon offset company. We sort of track how many CO2 has been offset. So sort of these kind of things. So for us, I think it's much easier than for some of the other VCs, because it's sort of most of the time really the business metric is also impactful in terms of the new energy consumed. But I'll stop there, and we can. I forgot to show some of the cool slides that I have, but maybe I'll have the opportunity later.
You're very welcome to show them, and maybe and I just to echo it, I think your position is something that is to some extent understandable in a way. Like, there's a lot of obviously pressures on founders to do all kinds of work. Also, obviously, it's a very kind of well-established pattern that there are pivots of varying degrees, sometimes very, very strong ones, that would make a set of kind of maybe indicators that you would previously track a little bit obsolete, so they would have to be kind of changed, right? But at the same time, I think there seems to be also some in a way luxury that you have because of just the nature of the sector that you're in. In a way, it's kind of easier for you maybe than for others to quantify the kind of impact you have, and maybe the conversations are just much more direct. Plus, you obviously have the industry expertise to really kind of in a way point directly, to whatever kind of metric might be most applicable for certain startups that you kind of look at.
100%. We definitely do have this luxury, and we can definitely do more. But so we have the luxury not to do much more for the moment. Obviously, what we've been seeing, you can go so many levels deeper. With this electric bike, with batteries, with everything. With electric bike, you can look at where the battery has been produced. You can then look at where the batteries materials have been mined, right? You can look at how it was transported. So all these things, the whole supply chain tracking, logistics, and so on, and how it's being delivered to the couriers and so on. With the offset, and we had some of the funds sort of diligencing our early stage carbon offsetting platform, and the guys sort of working to really set it up, to get the API going, get the product going, get some of the offsetting projects around the world set up and get the contracts. Then the funds, sort of later stage funds, come in like, look, let me take a look at the list of the offsetting project that you use to buy those credits, whether that's a forest somewhere or hot stoves in Africa or something, and they look at it, point out one project. Look, I'm not sure I like this one. I'm not sure it's sort of good enough. It could be better. I was like, look, this is still a seed stage company, right? There's so many things they care about, and just by changing this one thing could be just not optimal at this point in time. So sort of, I think there could be some short-term sort of maybe what's the right word? Short-term things that you could sacrifice in terms of impact, maybe not doing it 100% perfectly, but to make this business viable and to actually get it off the ground, and it will be much more beneficial for the planet. It will be existing, and it will be doing the right components for electric bikes. It will be doing better batteries for the electric bikes. But if you force the business to do everything 100% now, very likely it will fail. It may be that bike will be too expensive. No one will buy it at the end of the day. And Vlad, you just one good point, I think, in your presentation, sort of, can people pay premium for impact? And it's really a big discussion. Can B2C can consumers pay? Do they pay? How long they want to pay? Do they pay in crisis? Everyone can pay in bull market, what they had for 12 years. Then can businesses, corporates pay premium, right? Yes, they can pay up to a point. They can pay for PR. They can pay because the CEO, of Unilever, maybe Paul Polman, pushes it. At the very end of the day, I still do believe if it's just way too expensive and it's not better and just has some sort of greener thing, I don't think it will work in the long term. Long term could be 5 years, could be 7 years, but I don't think it will work. So in clean tech space, we've seen it's a huge discussion, clean tech 1.0, 2.0, but things are starting to work at good margin. Finally, given the solar's going down so much in terms of price, batteries, electric cars, EV charging, everything, it's finally starting to work. So that's why we're big believers in the industry, that it can have both.
So I think this is a really interesting point. Yeah, I'd love to invite actually Camilla to just comment on this, because it seems like one of the questions is there like almost like a trade-off, between like the probability of a business surviving and the focus on impact, right? And maybe it is not actually like a mutually reinforcing circle, but more like something that needs to be kind of carefully balanced in a setup.
Yeah, no, I think Thomas made a really good point. Like, you need these businesses to have the impact that we all want these businesses to have. They have to get to scale. and like all early stage companies have to make trade-offs on that scale journey. And so there is a point, like consumers don't like to pay. There's a small segment of consumers that will pay a premium, but the majority of the market won't or can't afford to pay a premium. And so you have to have companies that are at a commercially viable price point, and that can mean sort of a trade-off. And that, I think, is where it comes back to this intent piece. You sort of want founders that have an intent to change the world, but they recognize the way of doing that is to get to scale as a company, and that there's trade-offs along the way. We often talk about it in, we're a business invested in a business called Gusto, which is a sort of food kit business. We invested in that super early, and at the time, Timo, who was the founder, he always talked about wanting to remove food waste from the supply chain. The model itself reduces a level of food waste because they take out, they send like exact portion sizes, so you don't have waste in the home. But you know, of the 40% food waste that happens, the majority of it happens in the back of the supply chain. And his unique insight was, he was like, listen, like all these grocers are like negative gross margin, like this food waste is like a massive margin opportunity. We just need to find a way of like chopping away at this until we're at 0% margin, and then we can drive half of that into price reductions for consumers, so they're going to love it, and we can drive like half of it into being more profitable, so we can continue to grow. But then at the same time, they have lots of packaging because it's a direct consumer business, and so they've done lots and lots of work around the trade-off between like food waste and packaging. And for a long time, they found that actually you created more damage by removing the packaging because you had a huge increase in food waste. So they were like, why don't we fix food waste first? Once we fix that problem, now we'll fix packaging. And in the last year, they've taken out 50% of packaging from the sort of supply chain. But if they try to do both at the same time, there's no way they could have scaled in parallel with that. And so there is just a bit of pragmatism around like having to have a vision, but then like incrementally execute into it rather than trying to do everything, getting uncommercial and then not getting to scale.
Oh, I think we lost our, oh, he's back. There we go.
I'm back. I just lost the very last part of it, but everything else was super clear. So thank you for that. Maybe just to put both of you on one point, like, so there's this kind of idea, right, that is really difficult to quantify, but that for kind of that there are those kind of more tangible benefits, even if they're difficult to quantify, for running a more kind of impact-focused business, right? In terms of the ability to attract and motivate and retain talent, in terms of customer loyalty or sales, in terms of turning regulatory shocks in an advantage rather than, you know, something that kind of haunts you all the time. As you grow bigger, you know, maintaining access to capital markets, being included in certain ETFs, but also having access to something like kind of, you know, impact-related loans. For example, there's this kind of ESG loan movement where your interest rate in a way depends on your ESG performance. How do you see that? Is that all kind of like a little bit wishful thinking, or do you think no? I mean, there's real benefits to be kind of reaped in a way by impactful companies, even if you can't really quantify them as exactly as you might want to.
I can start, Vlad. I think it's a bit frustrating when in your question you give all the best bullet points that I wanted to give. So I'll have to think of something else. But the retaining employees, definitely trivial sort of answer, but definitely works. I've seen, you know, help recruit quite a few folks for our portfolio companies, and you know, from the chats with them, it's always, look, you know, they will care about the salary, they will care about the compensation, you know, that's what they live off, but they will also deeply, the best ones will also deeply care about, you know, this is cool business, this is sexy, this is, let's say, mobility, but I love it, you know, electric bikes, you know, sort of the future, I can be a part of it, you know, just this feel good feeling every day, you know, to come into work. So for sure. And some of them maybe more technical things, not to take too much time, I think even EIB, you know, itself, the venture debt products that EIB gets, if you will probably give it, I'm not sure all the pockets they have, but you know, from our startups, there's so many programs set up specifically to really propel this industry, you know, venture debt with fantastic terms for, you know, green startups, you know, whether that's mobility, energy tech, maybe sometimes it has to be more sort of capex intensive and European focused, European real talent focused, but that those kind of things, you know, better interest rates, you know, maybe talking about more public companies, but, you know, ability to issue green bonds at just ridiculous interest rates, all these things that I think in general, the great point you mentioned, sort of this regulatory risk, I think the world is moving. We see every day announcements from SEC, from, you know, everyone in the space, from new administration in the US, or the new regulations that we're going to impose on, you know, all the bad guys, the old guys, or the regular guys who are not doing enough. You know, maybe sometimes it's not going to materialize, it's just a lot of wishful talking, but probably I believe over time it will, you know. So I think if you are, why not do this in this great industry that's the future? You avoid all this hassle that you would do otherwise in those other industries. So I think definitely very tangible benefits and a lot of less headache in the future.
Thank you for that. And Camilla, what do you anything to add to that?
Yeah, I mean, probably very repetitive. I mean, the talent is crazy. Like, I think that's the one thing we've seen with the sort of shift in focus, is just like the portfolio companies are attracting incredible people at a really early stage, and the key reason they're giving for that is because the companies have a mission they want to get behind, and we're actually seeing people take very sizable salary reductions to join some of those companies, which I never thought was like truly possible, but being proven wrong on that. And then that sort of, I guess, creates a virtuous circle of like incredible talent attracting more talent, and not like lower salaries also allowing better capital efficiency in those companies to sort of grow in a really efficient way, which has been super exciting.
And maybe just to follow up on that, so would you then see some form of impact premium on those companies if you can kind of prove it to your follow-on investors, or have you actually tried in a way arguing for a higher valuation because those are impactful companies, because they have those benefits? Or would you say at the end of the day it's still like very financial metrics focused? We want to see the MRR contracts, the ARR contracts, the client testimonials, and that's what really matters, and not really whether I can show you kind of my impact metrics over the last 1.5 years.
So I think short term it's really tricky to tell. I think of our very small sort of portfolio, I mean, 2 out of the 3 investments we've made have sort of closed significant up rounds at really good valuations, but it's very difficult to tell if that's driven by the sort of impact aspect, or whether that's just driven by the fact they're really fantastic founders building really great businesses. I think our hypothesis is when it comes to exit, there will be an impact premium, because you can see capital both in the public markets and in the private equity markets moving into this arena and actively looking for assets in this space. And there isn't, I guess, a deep enough supply of scaled companies that have this really strong sort of shared value, like commercial impact sort of angle to them. So we anticipate that if you scale it forward sort of 5 or 6 years, as some of the companies that are startups today start to come to exit, then there definitely will be that premium at exit. I think you're seeing it a little bit in the CPG space. So, you know, all of the companies Unilever has acquired over the last few years have been sort of B Corp mission-led brands, and they've paid like very good multiples for those. A number of the other CPG companies are now starting to sort of follow suit and say they want to do the same thing. But it definitely feels like it's nascent from a market perspective.
Yeah, that makes complete sense. Tomas, what was your experience with kind of trying to get an impact premium, or your plan for doing so?
For sure. Again, as Camilla said, sort of short term, hard to say. I think from our point of view, it's what's been happening in the clean tech space over the last 12 months, especially with the arrival of SPACs, has distorted the market so much that I just don't know what's real and what's not. I think that's the bottom line. And also this hype sort of also driven all the generalists, so many generalist VCs carve out a part of their funds and start chasing those type of deals. So we've seen an insane amount of increase in the competition for the deals in energy tech and sort of electric mobility space. Just incredible. What, you know, 12 months it's a short period of time, but the things have changed immensely. So that impact premium, I don't know if that's sustainable, right? We've seen ridiculous multiples for SPACs in the EV charging space. Just ridiculous. Some of these companies will go bust. You know, I don't know what it's driven by hype. That hype itself is driven probably by the retail investors, maybe with the Robin Hooders that can back those, or by sort of what influencers of the Wall Street like Chamath Palihapitiya, or other guys that sort of gets the retail army. I don't know. It's good on one hand that people talk about it. It's good that people talked about Nikola Motors, a fuel cell trucking company. It's bad that there was a sort of semi type of fraud behind it, so ups and downs and pros and cons of that. I think the space, it's a long discussion. So I think impact premium definitely, not impact, sorry, clean tech hype type of premium these days for sure. I don't think it's going to be that sustainable. Maybe it's going to be some sort of premium, but not this type of premium what we see nowadays. I think it's just too much, in my opinion.
Yeah. No, I mean, yeah, I agree, especially in your sector. The multiples and the valuations have been just insane. I mean, it's hard to justify that with kind of the real numbers of the underlying companies, for sure. That makes so much sense. So I guess maybe just like taking a step back and kind of reviewing the landscape, right? There seems to be some impact investors that I mean, if you just look at the various posts, there are so many impact investors that have now come up, so many different funds. How do you see this trend? I mean, on the one hand, we mentioned that having more capital is good. On the other hand, I mean, maybe those are some extent also your competitors. Thomas, you said that you are running a collaborative process anyway. But like, why do you think? How much of those funds are actually sophisticated investors and they pursue a fairly well-founded investment strategy, and how many of them are trying to jump on one of the impact trends that exist, whether it's education or climate or any of those kind of verticals? Maybe Camilla, starting with you.
So it's always really tricky to say. I'd say it's very difficult to raise a fund. So I think most of them probably do have sort of sensible credentials to have been able to sort of, raise institutional funds that they've been able to deploy. I think generally we're really positive of more funds coming into the market. When you look at sort of penetration of venture investing in Europe compared to the US or China, it's still very low on a sort of per GDP basis. So there's still room for more venture capital. I think generally when you look at some of the stats around like the companies that go on to be successful, they've often had like 3 seed funds in a very early stage, which sort of suggests that actually like the ecosystem is more collaborative than competitive, and to build really fantastic companies, especially when they have like high degrees of innovation or sort of, CapEx risk, which Thomas was talking about, it is capital intensive. And so really the more capital comes into the market, the higher chance is that some of those start to really scale and be successful. So we'd view it as more of a positive than a negative if that sort of money flowed out to the market.
Thomas, anything to add on it?
Yes, I definitely agree with Camilla. I think I haven't seen this sort of greenwashing or impact washing in VC yet. Maybe I hope I won't see it. It's hard to raise funds, and you go through a large due diligence. So just jump on that bandwagon very quickly. I think it's hard. Probably we're gonna see some of that come out. I have seen a lot of it, and everyone has seen all of it in the public space. Indexes that suddenly become sustainable overnight, and you look deeper into them, it's like, oh man, come on, seriously, that's you change one ticker and then suddenly become a sustainable ESG driven index, and you still have I don't know, Coca-Colas and stuff of the world. I think and it's much easier to trick the retail investors, who especially nowadays, they don't do much due diligence. Sometimes they do and they don't really care, but they know that ESG equal return, so they will just go for it. So I think that topic is much more dangerous in the public space than VC private money space, early stage especially.
Gotcha. No, makes sense. And with this in mind, maybe one very last brief question to both of you. What would be your advice to entrepreneurs in this context? Like how should they think about their product? What should they kind of think about when speaking to VCs, and how should or shouldn't they kind of measure the impact if they wanted to? And maybe starting with Thomas this time.
Yeah, for sure. I think the only suggestion is, look, there's a lot I think I like Chamath's Polyhapitia's quote that the first trillionaire in the world is going to be made in sort of green energy or renewable space. I think that could be right, whether that's Elon Musk or someone else. So I think there's vast opportunities, you know, whether you think about money, whether you don't care about money. I think there's vast opportunities in this space. Maybe sometimes feels like, oh, this thing has been invented, this thing has been done, you know, another delivery company cannot happen. But we've seen with the likes of DoorDash, it can be done, it can be proved. And especially in this space, it's all coming. It feels sometimes like things have come already, but I think in mobility, in energy, clean tech space, everything is in the future. So definitely roll up the sleeves and do things here. Try.
Fantastic. Camilla?
Yeah, I just say like combine really excellent execution with a vision. So I think it's awesome to have a vision, but you know, it's got to be backed up with like really stellar execution. Sounds a bit boring, but
it's the truth. It's the truth. Well, guys, from the bottom of my heart, thank you so much for joining and sharing your perspectives. This was engaging, informative. I'm incredibly grateful for you taking the time. Also, thank you to all the listeners. We have some of them here. I know many more will watch the video later on. And yeah, to everyone else, please join us for the next session where we're going to focus on actually some of the thorny questions around impact management and impact measurement, and how you essentially, if you actually wanted to kind of build a system that in a way, you know, switches can kind of support your pivots and kind of show some genuine, in a way, intent to be an impactful organization. That's kind of like the topic of the next session. And yeah, again, Tomas and Camilla, thank you so much for being with us here today. And I can see already Luisa having kind of launched the survey. So if you have a quick moment to fill it out, that would be much appreciated.
Yeah, I just wanted to say thank you to you, Vladimir, and to Camilla and Thomas for having joined us today. I've seen that there were some questions that just popped up, but I'll guess that we have an opportunity to answer them in the following 2 sessions in the series. So wish you all a great Easter and see you in a couple of weeks for the 4th webinar. Thank you.
thank you.
Thank you. Have a lovely day. Bye.